3 completely different situations, all reaching the goal of building their portfolio.
That's a perfect scenario flow, as if you start a foundation, then went to momentum, and then went to passive.
We're going to be talking about 3 different scenarios, unpacking the different incomes, structures they need to consider, and mistakes that can often be made along the way to reaching their financial goal.
I think the most common mistake, because it's their first property, they seek guidance from family, they're quite young. The core mistake is
Arjun Paliwal, property investor with a $17 million plus portfolio and founder of InvestorKit buyers agency, walks us through 3 different scenarios, starting from the young and ambitious on around 90K.
When we look at Jimmy, we've got this 30-year timeline at 55. You don't have to do all of the 3 or 5 properties today.
To a more mature family of Mark and Sarah with a higher combined income of around 300K.
With Mark and Sarah, they have an opportunity with their income, their equity, to tactfully use that to be able to
all the way up to a high-flying corporate executive who's got a lot more income but wants to achieve the goal in a far shorter time frame. Let's talk about Sanjay.
You got less choices and you got to be very aggressive. That's the key.
You guys have asked for this episode and we are creating it. Portfolio planning from 3 completely different situations.
All these scenarios I'm giving you are not what if. We've helped over 1,000 property investors. That's the beauty about this. It can work. And the variables to consider are:
if you've been wanting to understand more of the detail on building a property portfolio, whether you're on a lower wage, middle income, or even a high income earner, you're going to enjoy this episode. My name's Todd Sloan. This is the Pizza and Property Podcast, and this episode's powered by Property Strats, InvestorKit, and Suburbs Finder. More about our amazing show sponsors in the show notes below. But right now, let's jump into the episode with Arjun Paliwal. Arjun Paliwal, it's been a while since you and I have sat across from each other.
Mate, it has. And I found it weird just to hear my full name back. I think like Arjun Paliwal, like out loud, just like I'm starting to notice it feels weird just to hear it. But then Arj is what I get all the time, or Arjun. But
does it remind you of like getting in trouble? Your dad being like, Arjun Paliwal, like yelling at you?
It's probably more like Arjun Paliwal. It wasn't quite that. It was like, yeah, I was like, Arjun. Like really loud.
Oh, mate. Well, look, full name, nickname, I'm just glad to be sitting across from you because we're going to be pulling apart portfolios from different levels. We've done this like in some different ways recently on a few different episodes, but you guys have been requesting it from a whole bunch of different scenarios. So Arj has been kind enough to actually put a whole lot of research into this, breaking up some portfolio planning from incomes, mistakes being made along the way, structures to really consider at different points of your portfolio journey, and also some of the keys to get there faster. Now, all this starts with a goal. If you don't have a goal, you don't know where you're going. So, Arj, do you want to talk us through a little bit about these 3 different scenarios, who they are and what their goals are?
Yeah, absolutely. So the first scenario is like, we call it the young ambitious climber.
All right, so Jim, the young ambitious climber.
That's right, Jim's property, huh?
Yeah.
So we're going Jimmy here, the young ambitious climber, and really that person is someone who's maybe in their late 20s, mid 20s, even early 30s as well. But I guess the key thing here is they're in that career growth phase, but they haven't yet caught that massive fire in the career. It's not into those senior roles just yet, but they've done a bit of savvy saving and they're probably on something like 90K of income. And they're at that journey where they're like, okay, my income's rising. I've got a bit of savings. I've got savings habits and I'm thinking of getting my first place. So that's the first person.
Got it. And what's Jimmy's goal?
Yeah, so Jimmy's goal is around that 100K in passive income. And because we're starting young in age, Jimmy has a lot of time. So we're going to be really conservative and assume that Jimmy doesn't get rapid income growth, any more major career progression, no major businesses. It doesn't win the lotto pretty much, right? And essentially there's just this consistent income growth with wage and inflation impact over time. And Jimmy's aiming for 100K over the next 30 years, which would still be about, 12 years earlier than retirement if you get there and you start at 25, say?
And that's if they don't move the goalposts again in Jimmy's lifetime, because didn't it used to be like early 60s and it was mid, then now it's late?
Absolutely. And you're still like, well ahead of that, right? So that's helpful.
100%. And the thing I like about this as well is because this isn't shooting the lights out. This isn't building a 10, 20, $30 million portfolio. And this isn't also going full sacrifice mode and doing it in like 5 or 10 years. This is Jimmy just going, I want to make some smart choices. How do I do that?
Yeah. Absolutely. And that's totally possible because all these scenarios I'm giving you are not like what if or this potential. We've helped over 1,000 property investors. And so from that perspective, this is real life stories we see. And also this isn't just real life stories we see today and hypothetically they could get there. We've been working with some of these clients for 6 years now. It's coming to 7. So I think the key here is that it's a lot of real scenarios that we're mapping out here.
Awesome. Now, who's the next? What's their situation?
Mark and Sarah. We'll
Mark
give that
and
a go,
Sarah.
right?
Okay, perfect. And how old are Mark and Sarah, and what are they? What's their goal?
So Mark and Sarah are in their 30s. They have a young family, maybe one kid or having one soon, and they're a couple, right? And they're both in their 30s earning some good income. Usually the household income here is about 300 plus, or you could put it in a range of 300 to 500. But essentially they're both corporate professionals or in certain jobs, and they're in that position of earning. And Mark and Sarah will say they have a family home too. So they've got their home and they're now looking to expand with investments.
Got it. And their goal?
So their goal is to get to a passive income of between 150 to 200K. And remember, with all the passive income numbers, we're talking about inflation adjusted. So it might be like 200 to 300K, but in today's dollars, it's 150 to 2 as an example.
Yep.
And they're looking to do that by 55. So instead of having the 30 years, they've only got the sort of 20 to 25 max.
So still a good time frame, but obviously a lot less than Jimmy's got to play with.
Absolutely.
Got it. And our last guy, now he's got the shortest time frame of all, 55 years old. He's on a pretty good wicket.
We're calling him Sanjay.
So Sanjay, he's 55 years old, and now he's on a very good wicket.
Absolutely. So we're talking high profile corporate executive. We're talking directors of companies. We're talking business owners, whatever it may be, across senior roles on 500K to $1 million of income. Now, businesses could earn much more in revenue, but this is the income that goes to that person. And that's Sanjay. And now we're talking, hey, look, 5 to 10 years maybe of investing life, and they want to be okay by 55 to 60.
Okay. Now, just in case you're listening to this and going, 500 grand, who earns that? This is obviously not the average scenario. Right now, we're breaking this up. So Jimmy's on a lot more of a normal income for a lot of people in the kind of mid-20s, and some people still end in their 30s and 40s. So maybe if Jimmy's scenario is one that relates to you more, that's going to be the one that's applicable. If Mark and Sarah, you're looking at going, yeah, I kind of get that. We're on around that kind of $200,000-$400,000 a year as a couple, then that's going to be more applicable for you. Sanjay, I'm actually just personally interested because to me, this one actually is just going to have a lot of takeaways that even if you're not identifying with Sanjay's situation, being able to get there within like a 10-year period, we're giving him what, 55 to 60?
Yeah,
or?
we'll give him a 5 to 10 year period, so it's 55 to 60, and we're aiming for a bigger number. We're calling it around 2 to 50K in passive income, inflation adjusted. And with Sanjay as well, we're saying that he owns his home and has upsized throughout life, so it's a pretty gnarly home.
Okay, so Sanjay's definitely got some serious capital to lean back on, but he's got some like really big time constrictions.
Correct. So it has to happen fast. The whole life has been keeping up with the Joneses, moving from the affordable unit in his early career days.
Yeah.
And now he's probably got a 4, 5, 6 mil home. And look, maybe it's not just keeping up with the Joneses. Maybe he's enjoying life, providing a better area, maybe something for his family, traveling a lot. But it's all been home, paid off, not sure about investing, and really locking in on that home and paying it down.
Do you meet many Sanjays?
A lot. A lot. Yeah. So as whilst you're talking and you mentioned the average scenario, I get that. You're right in terms of the broader Australia, but we meet a lot of Sanjays. And I mean, like a lot of them are called Sanjay too. So I mean, a lot of Arjuns, a lot of Sanjays in different sort of positions. But yes, we do have a lot of 500K to 1 mil plus incomes that are business owners or corporate executives.
You're going to get a phone call after this airs from Sanjay, aren't you?
Yeah, he's going to go, why are
you talking about me?
Don't talk about me, man. I'm like, no, look, no last names revealed, and we're keeping it private throughout.
Done. All right. So we're talking income, mistakes, structures, and keys to get there faster. Why don't we start with Jimmy? And do you want to start with income, or what do you want to start with this?
Yeah. So at the end of the day, we got that 90K income, and look, interest rates will fluctuate throughout, right? So borrowing capacity will range from the last 6 years that we've been helping someone. But in this investing scenario, I want to firstly shout out 3 different stages of investing.
Okay.
Right. We've got 3 types of assets that we purchase for clients, and the 3 types are foundation, and I'll just draw the F there for foundation. Then we've got momentum, and then we've got passive, right?
Okay.
Now with foundation assets, they're typically there from a mindset perspective. They're not there from a results perspective. And this is interesting.
What do you mean by that?
Yeah, so I found that no matter how much good content there is on podcasts like this or the internet or books you read out there, no matter what you say or hear, sometimes people just aren't open to looking at all cities across the country and trying to find the best growth with the best price to yield ratio.
Okay.
It just happens.
Yep.
Comforts kick in. I want to be in capital markets. I want to be in a major city. I kind of want to be close to me, but it doesn't have to be too close. I'm open to this. I want to be where these major jobs are. I want to make sure that this 20-year, 30-year history of this market has less volatility and it's a bit more stable. And you see these things time and time again. And as a result, it's important to go, yes, let's respectfully challenge that through all the content, through all the sharing, the insights. But sometimes it just doesn't get through. And that's okay, because here's why. If someone went and did invest borderless and they got a property, and then maybe the aircon bill's $2,500, but in their local city it's $1,200. Or maybe the council rate's $3,000, but in their local city it's $1,800 per annum. Or maybe an insurance bill's $3,500 in some city that's smaller, but usually it's $2,000. And they don't holistically look at everything; they just look at things in isolation. But
so that triggers that negative feeling of like, see, this is why I didn't want to do it, or is that kind of what you're getting at?
Yeah, they're like, no, I don't want to do that. Oh, I'm glad I didn't. And you know what? The sad part is, these people often give up on property investing completely.
Yeah,
and they're not about looking at it holistically, because maybe that, give you an example, Townsville over the few years has had high insurance and high council rates, but the rents are much higher. And the growth has grown, over 20% in most of Townsville just in the last 12 months, over 40% over the last 2.5 years.
So who cares if your air conditioning bill is an extra $1,000?
Correct. But that mindset may have locked them to go, I don't want to consider that market at all. And if they'd gone into it, they may not go into property again, even with the big growth. They may have thought, oh, I don't like this and I don't like that. Or maybe the maintenance is something. I've seen that where someone isolates the maintenance, but they don't think of the growth. And this is because you're programmed in a way. And when you think of those things, it's a big change for you. And so as a result, you kind of get turned off it overnight and it doesn't become your thing. And I just don't want everyone tuning in to suddenly think they have to make this completely uncomfortable decision all the time to get great results. And then all of a sudden it tests their comforts and they never get to where they want to get to.
So you're basically saying that if, let's say you look at it and you got best choice to worst choice, and it's like you might not be making the best choice, but as long as you're not making the worst choice, if you're more comfortable with a choice that sits around 7, best is 10, worst is 1, it's like, okay, well, make the 6 or 7 choice. Don't maybe make that 10 choice if you know you're super uncomfortable with it, because then you could backpedal later and then just stop making any good choices in property moving forward. Is that basically what you're saying?
100%. And to give you one example, Melbourne units over the last 10 years
they're bad.
Have only grown just over 4% in many parts of Melbourne, right? And so if you look at 4%, that's your worst decision. That's like, don't make that. But then maybe a Melbourne house in many parts of it over the 10 years has grown between 55 to 75%. Is that the best over the last 10 years? No.
I getcha.
But is it a horrible decision?
Yep.
No. But then now you go to an Adelaide house over the last 10 years, it's grown over 120%. Then, okay, you're saying something now, like that's the best decision, right? So I think this is kind of it. It's like there are mindsets that if you push them to the best decision, they just don't make it, or they get stuck, or they kind of feel like, well, this doesn't suit me and I'm now not going to make any decision again in the future. But then you could have that middle to best and get that balance. And that's where foundation is. It's like major markets, it's houses, it's satellite cities. Like if you're in Adelaide, a satellite city is Barossa Valley. If you're in Brisbane, a satellite city is Toowoomba. If you're in Sydney, it's Newcastle and Central Coast. It's balancing comfort, but it's not just focusing on bad results for the sake of comfort. It's still looking at good results. And that's where foundation could kick off.
Makes sense, huh?
Now we've got an foundation, and now you go to momentum. Momentum is all about affordable markets, and we're looking at the balance with affordability, but we're also looking at growth, and we're looking at yield together. And we're truly all over Australia. So it's a big circle here to just be like, you're all over. You could be in this city, that city, this city, this city, just borderless, right? And you have to look at the market for where the best data is. So with foundation markets, we often find people being in that sort of 600K all the way up to even like 1.2 mil, sometimes higher, depending on them. With momentum markets, we see people at sort of 500K, and they even go up to sort of that, 700K maximum. And the key here is that they're looking for affordability and yield balance across the country in momentum, because usually if you've acquired a couple of foundations, it's like, how much more borrowing capacity do you have? But then with the foundation properties, they're usually bigger purchase prices, as you can see, because they're in those more comfortable markets. Gotcha. And then we move to the last stage, which is passive. These purchase prices are usually 1.5 million all the way up, and this could go on and on, like, even 5 million plus, depending on the position of the individual. And the goal here is to get into commercial property. And you're looking at high yields as the core focus here.
So we're talking like large unit blocks, shopping centers, like retail, that kind of stuff.
Absolutely. And so you're kind of going from what I call like the anchor, then you're going to the diversity, and then you're going to income, right?
Anchor, diversity, income. Okay.
That's the way we're building out portfolios. Now, I share this because that's the core thing to think about for all three of these scenarios. But what the difference is they each have different income, They each have different age or life stage. They each have a different current position, and they have different goals, right?
Okay.
And so it's these core points that are the differentiators for where you start, where you're progressing through, and where you're going, right? Now let's jump into Jimmy. So we're going to draw Jimmy up over here. And we're stick figuring everyone. So everyone look the same pretty much.
He's looking trim.
Looking trim. Yeah, give me Jimmy's ring. I'll take that. And so from that perspective, when we look at Jimmy, if we extend out the timeline and we say we've got this 30-year timeline at 55, I think one of the first things people will look at is that they'll think 90K is not enough. I can't buy the 3 to 5 properties, right? But it's important to realize you don't have to do all of the 3 or 5 properties today. 90K might get you the first. But remember, over time, there is income growth. And remember, we're not going crazy income growth. We're going, 3% wage growth, maybe numbers, maybe 4%.
Might get a promotion.
Here and there.
Yep.
Right. And we're also being really conservative and assuming that Jimmy doesn't get any partners, major promotion, double income. We're just going through life.
So he's not starting a business. He's not shooting the lights out.
Absolutely. But what we've noticed from Jimmy's scenarios that we've helped out in the past is that usually they get between 3 to 5 properties maximum. And the key here is that if they go beyond that, it's not about the structures and things that we'll go through that they can do. It's that they also have to manage the cash flow to pay for these properties and make the repayments too.
Is this because Jimmy would typically stay in the foundation property lane? Is that kind of what you're saying?
Well, interestingly enough, I think Jimmy's budgets usually in that income and that age don't start with foundation. And that's the thing with the 3 stages.
Yep.
With foundation, momentum, and passive, that's a perfect scenario flow as if you start a foundation, then went to momentum, and then went to passive. But there are many scenarios that don't start there because we're coming back to income, age, current position, and goals.
Gotcha.
Right? And in this particular case, Jimmy kicks off at momentum. He's got the budget, the borrowing capacity for an affordable purchase price, and he's looking at that affordable purchase price, and he's looking to see where he can go across the nation for it. And it's usually being broad and also having the well-placed yields to balance that.
Got it.
So yeah, that's where Jimmy would be more momentum investing.
So what kind of mistakes do you normally see like someone in a Jimmy situation making around this kind of time?
I think the most common mistake here is that because it's their first property, they seek guidance from family, they're quite young. Many Jimmys are probably living at home or renting.
Got to be north facing, that kind of advice.
I mean, it gets even worse. It's like, be in the suburb. It's a great area. Don't go outside of your city. Buy a unit. It's your backyard. You should property invest. I don't know why you're not getting into property investing. Get into it young. Get it going. This is a good spot. They've got a new train line coming up. It's basically the core mistake is family guidance, backyard investing, and buying a unit. And this is the most common thing we see with the Jimmys out there. It's the unit that they bought close to home. They come through, now they're getting to their 30s, and they reach out to us. And we go, great, Jimmy, nice to meet you, and how's investing been? Not so great. I bought a unit in my 20s. My parents gave me some guidance. I'm now in my 30s, thought I was doing a good thing by looking after my savings, getting a job, finishing uni, got an affordable unit, listened to my parents. They did well from property. Well, your parents have a house, right? Your parents have held a house or upsized houses for many years. Your parents have held it for decades. Your parents are telling you to buy a unit, and that's the big mistake. In Melbourne's case, many clients have had that scenario, right? And so from that perspective, and Sydney too.
You said the other day, you were talking to someone that, what was it, that they were held it for almost 20 years?
Yeah, they bought it at, I think, just when they turned 20 or just before.
Yeah.
They're now well into their 30s, and so coming to like 16 to 17 years, and they bought it for low 400s. Now it's worth 330.
That's just beyond insanity. So it's costing them money.
Yeah, we bought 2 properties for them, one in Adelaide and one in Toowoomba. And within 12 months, that's grown more than like anything that they've had obviously before in 18 years.
So what do you say to anyone that finds it a little bit difficult to maybe break the family mold? Maybe mum and dad are pretty like, yeah, you got to do this. How do you guide that?
Look, it's tough, and it's tough coming from an Indian who has the family all living together, right? So I'm still like influenced by family all the time. I've got 12 people in my family all together, mother-in-law, stepmom, dad, we're all together. So I know from someone who's like been living in that environment, it's tough. Now, what I would firstly say is that it takes a bit of backbone here, but it takes that backbone to go, like, you've put in the hours, you've worked your butt off, you've done the savings, give it a go on your own, right? That's the hard part. And if you don't have it and you're going guarantor, it just has to have that educated discussion. And this is where professionals can come into the mix. When the kids alone, I say kids, you're not a kid at 25, but when the kids alone have gone back to their parents in these guarantor or gifts or other situations, and it's not anyone else but them, man, your parents always see you as the baby. Like my dad, I'm 32 now. You know, we've got a 8-figure business. I lead a team of over 40. I've got over 17 million in assets, and my dad still thinks I'm his baby. And you're just going to have to face that you're always going to be their baby. And so as a result, like,
even if they're not well educated on it, they're still going to want to try their best to help you.
Absolutely. And that's the heart coming in, not the them trying to be mean to you or anything like that. And so I think where I look at any scenario, even my own scenario, when I went borderless to invest, it's because I had a professional. And so when I said to them, no, it's not me, it's someone else, they felt like, hey, this is an actual professional guiding you. And so they were able to step back. And so that's probably my tip there, but that's the biggest mistake I see.
Okay. So making sure that you don't make decisions based on, I guess, heartfelt advice, but potentially very often the wrong advice. Talk to me a little bit about structures. Is Jimmy going down like the corporate trustee structure pretty quickly, or is he like kind of maxing out his own name? How is he kind of really maximizing what he can do over this 30, 40 year period?
Yeah, so you've got two things to think about here. On structure, firstly, Jimmy may go, well, I've done the math, and if I have 3 to 5 affordable properties in that sort of 450 to 750, which don't all get acquired at once. You may get one now, and then you wait for that income growth, rental growth, lending scenarios to change, and then the second one might come in your 30s. There may be a large gap between each purchase, and that can happen, and that's okay if your income levels of 90K aren't rising as much as you'd like. You have the whole 30 years to be able to get to this. And as long as you can acquire in that sort of first 5 to 10 or max 10 to 15 years, you're going to be in a position where you still have a large holding cycle afterwards, right?
Get the double on the double.
That's it. And so because of that, people like Jimmy may go, well, why am I going through all these complex structures? I'm getting to my number. I'm getting to what I want. I'll just buy in my personal name. And they get tax deductions throughout. They're able to hold it, and they're able to easily have like savings and costs as well. But then there are others that go, well, this is my initial goal. I may have bigger goals down the track. I may have changes in life. And this is where people consider family trusts. They may consider certain accounting vehicles that they should speak to their accountant and brokers about. But when they do, there are banks that have policies that allow you to get greater lending amounts through debt exclusions as properties turn positive in the future, right? Now, that will happen over time as well, but you're preserving greater borrowing capacity in these scenarios. So that is when the trusts come to light if you see your ambitions growing beyond the 3 to 5 and you add a big plus there, right?
So for anyone that's going, he's on 90K, he's not buying anything. Talk me through like the serviceability, being lower income. What options is he looking at?
Well, I'll give you some examples of real life purchases in today's markets, right? There are markets across cities like Mildura, Geraldton, Gladstone, Rockhampton, houses, right? In these cities. And that's just a few I've named. There's more, the list could go on, right? But these cities have prices between 400,000 up to 600,000 in purchase price. They've got yields that range from 4.5 to 6.5% gross. And at the same time, if you're leveraging to 90%, that deposit becomes minimal. And there are lenders out there that will give you that loan for that first one for sure. So that's kind of what the 90K does. And you're able to purchase across these markets as your first investment property, just as an example.
So, and this is coming back to it being pretty crucial for Jimmy to be open to being in the momentum category, because if he goes foundation, he wants to buy somewhere close to Melbourne, Sydney, it's not happening.
It's not happening because you're going to make the classic mistake. You're going to go 400K unit in Melbourne.
Yeah.
You're going to make that mistake again. So the key is you've got to be borderless if you're Jimmy. You've got to get professional guidance to aid your support here. So if you're having family conversations, if that's an important factor to you, if it's not, well, you don't have to have professional guidance. It's up to you. But the key thing here is that if that scenario is not going to change and you don't expect it to, it's unlikely you go beyond 3 to 5 properties, right? If you do, it's really time that was your friend and you're able to do it here with certain structures. Or if you do, you got to it early on with those structures, but you're a really good saver. Because remember, like, you need to wait till these assets go positive. You can't just buy them and be negative cash flow 1K per property. And then how are you going to sustain it even if you can borrow for it with creative structures, right? So I think the main thing here is that's Jimmy's scenario. Now, with Jimmy's scenario, to get to that 100K passive, say not including super, you're either going to get to these properties being fully offset. And so what happens is that there's going to be a certain line, and let's call this the line. And at this line, rents start growing to a certain level. Interest rates may have stabilized. Income keeps growing up over time. And it's gotten to a point where the assets aren't really chewing backwards into your cash flow. They're just starting to turn positive. And so now if you decided not to buy anymore, every bit of savings that you input into this is essentially going into your offset account or paying down your loan, however you've got that structured.
Okay.
So organically, they might start getting close to debt free. Not all of them, but at least 1 to 3 of them.
And where's this line? 10 years, 20 years, 15?
This starts happening between the 15-year onward, because you have 15 years worth of rent increases, wage increases, savings ratio increasing, and the property debt is not climbing because you've now finished purchasing.
So if he's done this right, he's about 40 years old and he's got a pretty healthy LVR now because he's got some solid growth out of there too.
Correct.
Correct. Okay.
And you start seeing the cash flow not impact you as much. And so now your savings is actually filling up the offset account. And so you're either going to have the offset account lifting up or you're going to have the debt go down, however you've structured your loans, P&I or interest only, right?
Got it.
Now, best case, 1 to 3 properties might organically get to debt free or fully offset. And this is where in a portfolio, you move through what's called the consolidation phase. Now, in the consolidation phase, you've got 2 angles. You've got the conservative consolidation or you've got the aggressive. And the difference between the two, in conservative consolidation, you're selling between 1 to 3 residential properties so you can have the remaining all debt-free, right? Now, that's basically then going to lower Jimmy's portfolio from, say, 3 to 5 to 1 to 3. And those 1 to 3 properties are going to be debt-free, right? But that doesn't give you the max income. Like that is going to give you the lower amount of income. You might just scrape through his 100K target of inflation adjusted, or you're just under, but the key is that you're very close to it. That's the conservative scenario.
Now talk me again, the timing. So this isn't around that kind of 15-year time. You're talking about this is basically towards the end when he's around that 50. And he's
Absolutely.
50s.
This is in your last sort of 5 years. This is like your consolidation phase to say, I couldn't clear all my debt. If you could clear all your debt and Jimmy was a great saver, then you're debt free. But if Jimmy couldn't clear all the debts that he had by 55, then something's got to go to make that portfolio truly sustainable passive income coming in with no sort of job required to sustain it.
Understand?
Right? And that's where 1 to 3. We hope it's 1. The closer to 1, the better. So more properties, you achieve your target or you're above it. But if you weren't able to pay as much down or offset as much up, then that number increases. Now, if you don't make your goal here and you're thinking, I want to go down the aggressive pathway, well, welcome to commercial property. Because the thing is, with residential property, you can see you need numbers, whether it's 1 to 3, 3 to 5, 5 to 7, 7 to 10. And why I say those numbers is it keeps increasing the bigger your goal is, or at least it's higher purchase prices but lower numbers. With commercial, this is the income game of a portfolio. But in this sort of scenario, you'd have to actually sell all residentials and you'd want to transition to commercial in full, right?
Why in full?
Well, because the thing is, if you're already committing to this income vehicle, you already know that residential just doesn't deliver the income of what commercial can.
So the first thing that comes to mind, which I know someone's probably going to put in the comments, why not just start with commercial?
Yeah. So the thing is, commercial requires a higher deposit count at the start. Right? So you're going to need anywhere between 20 up to say 40% to secure the property. So you may have 1 higher income asset, but then you've now got into 3 lower income, yes, but higher growth, higher value assets. And that's the part where Jimmy is able to leverage the money the best, is that you've got multiple residentials to take it up and grow wealth. Whereas with Jimmy, if they'd gone to 1 commercial, it wouldn't have been as easy to leverage. It would have been a lower purchase price. They would have taken much longer to get to the next one, and they don't get there. Whereas if this residential portfolios outpace the growth of it and you're able to get larger values, when you sell down and you get to commercial, you're likely able to get a bigger, more valuable, higher yielding as well, because more choice of stock in comparison to the commercials you were limited to when you first started.
Makes sense.
That's the key.
Yeah, okay.
Right?
It's because even if Jimmy was to get, let's say, a warehouse, like I'm just right now thinking like he's getting a roughly a $400,000 property. Let's say he's going to one of the areas you suggested before, like Gladstone, just for example. But then he's walking down the street and he's like, wait a second, there's a warehouse for sale here for $400,000. Even if it was literally the same price, if he was doing like a 90-10 LVR, so let's say he had like 40-ish grand in savings and he's paying some LMI along the way, because he's getting started, he might not have a truckload of cash like you're painting the picture of. Even if he was to buy that warehouse then might have a far better yield to it, but he now needs to put in like a 30% deposit, possibly even 40% deposit. So now his 40 grand has just turned into, what is that, quick math, 120 to 160. So it's like, it might be the same purchase price. It's going to take him a lot longer to save up 120, 160.
Absolutely. And by year 5, Jimmy may have purchased 800K worth of property if he went residential, 2 400s as an example, whereas by year 5, Jimmy might still be on the one commercial.
Yeah, or still saving for it.
Absolutely, right. And so that's the compounding effect that residential has. So this is Jimmy's scenario. If we're going back here, we're basically saying Jimmy started on 90K. Jimmy's got a goal to have passive income of 100K inflation adjusted by 55. And Jimmy recognizes it's going to take between 3 and 5 residential properties, of which the majority have to be debt-free, if not all of them, best case, but at least the majority. And then the debt-free will come from selling down residentials to have a lower amount of residentials debt-free, or the option here is aggressive, where they sell all residentials to move to a commercial, which will increase the passive income.
Got it. Okay. I like this, Arj. So as far as keys to get there faster, I feel like this is a lot of information to digest, and we're just still in situation 1.
Yeah.
What are there big keys that you want to highlight that we've already touched on, or is there like a big one that you're like, no, but wait, there's more, steak knives?
Yeah, I think the key thing here is that, look, there's personal factors. The biggest driver for Jimmy is going to be the income, right? If the income increases faster than what we've got in these basic scenarios, you're going to see either A, more purchasing for residential, which means greater sale and more commercials, or the offset account's more full that allows the properties to be more debt-free, so you don't sell as many when you come down to consolidating, right? You got more chips on the table left. So that's the big driver of income. Age-wise, nothing there needed because Jimmy's young, so he's getting started early, which is great. And then current position, naturally the changes of the current position as the income goes higher, and then the goals, right? If Jimmy gets to 100 and goes, well, maybe my goal's now 80, that's going to be there. Or if Jimmy waits another 10 years and wants to go for traditional retirement, loves what he does, then naturally super now kicks in, and it's another vehicle that would have been going really well for him, whether that's property, whether that's shares, whatever it may be, it's another stream of income added to what he had outside. So yeah.
Or potentially really help with the debt consolidation phase.
Yeah, absolutely. So if you didn't want to sell all of them, that super cash will come in at some point in the future to help with that, right? And then commercial ends up being that accelerator for him if we're not consolidating the residentials. And
just for anyone that's a little bit newer, talk to me about the difference between the yield, because like if you're getting a good yield right now in resi, you're anywhere between 4, 5 and 6%. It's
correct.
Possible to get higher. There's also a lot lower out there, but that's kind of roughly there. We are talking gross yield as well, though. Now, net yield in commercial, what's a good sort of net yield these days?
Yeah, the net yield ranges we target are between 5.5 net to 7% net. And by net, we're saying council, water, insurance, property management, all those things have been considered in there. And it's just the mortgage you pay with that money. Where in the residential, as you pointed out, you might be 4 to 6, but you've got council, rates, water, insurance, maintenance, vacancy, all these things to consider. Still consider vacancy in commercial, but there's a lot more in that residential mix that lowers the yield, and a 4 to 6 can quickly become 2 to 4.
So it's closer to really like a 7 to 10 if we were comparing them both to the gross.
Correct. If we're looking at both the gross, you're looking at 7 to 10. That comes down to 5.5 to 7 in commercial, whereas in the residential, you're going from 4 to 6, coming down to 2 to 4.
Yeah, big difference. All right, so what I'm really hearing here is income. If he can do everything he can with young Jimmy to actually increase it, amazing. But if he's not increasing it, he's still got a lot of options. They're just going to be a little bit different. He's got to make sure that he's going down the momentum path. He's got to open up his mind to it, because from what you were saying before, you're better off making a choice that you're still happy with. However, Jimmy's going to have some restrictions that he's got to deal with. As far as the mistakes that's most commonly made here, the family advice, the units, the maybe just sticking with stuff that's well-intentioned but doesn't really have the education piece behind it. And his keys to getting there faster is realistically like transitioning to commercial a little bit later on. If he can earn some more money, that's always going to help. But really, it's, to me, the actual thing that I'm really hearing is that consistency. Having that consistency early on, the difference between buying those 3 to 5 properties in the first like 10, 15 years versus buying those 3 to 5 properties over 20, 25 years. That's going to be a totally, like the same thing, but it's going to be a totally different outcome because you haven't had the same kind of time in the market.
Yeah, absolutely. And that's good old Jimmy for us.
Excellent. Let's talk to, what was it, Mark and Sarah?
Mark and Sarah.
We're not talking to them, actually. That would be, let's talk about them.
Well, Mark and Sarah's interesting stuff here. So firstly, they have a house. And that's a great starting point. So they have a vehicle to create a lot of their deposits. So usually the equity can come from here. They've also got a good level of income, right? So these 2 parts here are a tick. The third part as well is that to get a house, to have an income, to manage budgets, kids, or anything like that, they also have financial discipline, right? And so they have the monthly savings. So when we come back to that income, age, the current position and goals, they have a few good ticks here that make this really scalable, right? So that's the key starting point with them. In terms of where they're going now though, this is where they may already have their foundation tick because of their family home. That can count towards the foundation.
And what are we saying roughly their family home is worth? What, like
we could be here between 1.5 to 2 million, 1 to 2 million even.
Okay.
But that's their family home being on that 300 to 500K income. And with that, they've also paid that down a little bit too because they've owned that for some time. They may have upgraded from a smaller, more affordable property over time to being in their 30s and got a slightly bigger home because they now have a kid.
So how much equity would you assume they'd have?
Well, I'd assume that their loan might be placed between 600 to 800K in loans. So they might have between 300 to 500K in equity depending on how much that price of that property is.
Okay, so they've got a decent amount to play with.
Absolutely. So they might say the family home is their foundation here, but then with this couple, they might go, well, maybe we want another foundational property. And so this is them staying in that foundation for 1 to 3 properties, depending on their comfort. So it's a similar scenario here from foundation, momentum, passive. In this particular scenario for them, we can go across all stages, foundation, momentum, in those 2 parts, and then they can transition to passive as well. So there's some similarities here, right?
Okay.
And there's also some similarities in the acquire and then consolidate. So those 2 things still remain a theme.
Can I ask, 35 years old, do you find if it's like older couple, because like you just said, you're still your dad's like baby boy, okay? Even though like you've got kids yourself, is it still just as much of a leap in this age bracket for young families?
This time around though, there is influence still there always, but because they've bought a home, they've had some wealth generated, they have equity, a bit more confidence. They might not be at home, they might be out, they might be in their own place, right?
Yeah.
And as a result, their family might be separate. The conversations don't frequently happen as much. And they usually maybe don't talk about as much. They go, oh yeah, we got something down the road. Yeah, we're investing in that city. We got a person looking after us. So I just feel like the chats as a 20s, when you're talking to your parents, and the 30s, you're still the baby, but it starts to change.
Gotcha. Okay.
Now, in this particular stage, remember, they can go foundation and momentum. But the key things I want to point out here as the core difference, just because we've explained those concepts of foundation, momentum, passive, and when they might buy stuff or how many, the big difference here, and that is the downsize, right?
Downsize.
Now, the downsize is important because when it comes to them at sort of age 55, now at this stage, if that's their goal and they're trying to hit that number, remember the negative impact for Jimmy was that he actually had to sell income generating properties to get that level of cash flow because he wasn't in the income position to pay off all his properties by 55. He wasn't able to fully offset all his properties by 55. Well, the same thing here, that they might not be able to pay off their many properties that we buy them over time, but they have an X factor, and that's the downsize of their family home. When time comes at 55, and if you're in a family situation, the kids are grown up or they're thinking of doing their own thing, even if it's not 55, it might be 55 to 65, you get to a scenario here where the houses have actually been rising in value faster than units. And this curve starts to create some separation, right? And so when you've got a 1.5 mil place, you're suddenly downsizing at sort of $3 to $4 million or more, and you're buying in at $1.5 million as an example here, then you start having a lot of capital gains tax-free money. And this money can be used to pay or offset the debts across other parts of your portfolio. And so this is a big X factor. So now in their scenario, they're able to keep a little bit more residential properties, or have them, if they're going aggressive, consolidate all their residential investments and downsize their family home. And now they've got multiple commercials debt-free.
If they were both starting at zero, let's say, and actually let me not say zero, but what I've got in my mind now is you and I have talked about Rentvesting before, okay? And I know you don't Rentvest, I don't Rentvest. I've done the numbers, and Bianca and I have basically looked at it and gone, we've just had little Freddie boy, and it's like, we kind of want the family home for a little while to be very stable. If these guys were to Rentvest versus like having the sell down, I never look at this in that full picture of them taking the consolidation phase at like 55. Is it almost worth like the difference of the tax that you'd pay being able to go, okay, now we're in consolidation, we can downsize it. We've now potentially got millions tax-free that we can use to then actually offset all of this debt versus, we probably could have borrowed a bit more, but we're going to be paying a lot more in taxes when that's sold.
Yeah, so what you're saying is kind of comparing the Rentvesting to that scenario, right?
Pretty much.
And that's one thing with Rentvesting. I've always been a fan of it. Prior to this family home, I was Rentvesting. And the only reason why I went to this family home, not because of the home itself, was because I could actually fit the home big enough to fit all of us.
Yeah, it's pretty big.
Yeah, but the main thing is that was a family move, an emotional move. If someone's Rentvesting for some time, you get to Jimmy's position. If you intend to Rentvest even in your 50s and 60s, you're going to naturally have to sell some of your income generating assets in residential to transition and sell them to pay off some of the debts on your high income assets like commercial, right? But with the downsize asset, that's the upside that people often don't talk about when it comes to buying a home and not Rentvesting. It's as hard to work out figure because it's sitting there on the side, whereas Rentvesting conversations are usually about ins and outs of income. What's better for your borrowing capacity, how much repayments you'll pay or you won't pay. Because naturally the repayments are far higher on a home that's premium or a home that's large in comparison to the rent in almost all cities that are major.
Makes sense.
And so I get it from the cash flow perspective, but if you're able to get the home and you're able to invest on the side, get those 3 to 5 residentials, transition to commercial over time. And if you can't transition to commercial, well, your downsize plus your residential sales will get you a much higher commercial value or multiple commercials in this case. So
and we haven't even talked about super.
Yeah, absolutely. Haven't talked about super or supers because now we've got a couple, right?
Yeah.
So I think the key thing here is that the downsize is one X factor for those with a family home. And that's the thing to consider before we go into things like, what mistakes or other things like that they make.
Got it. So as far as structures for Mark and Sarah, what are they doing? Are they going a little bit more complicated and they're sort of like getting trusts set up, or are they keeping stuff in their own name?
Yeah, I would say it's much more common for the entities to come in here. With Jimmy's scenario, it's more like, hey, if you're only going to get 3 to 5 residentials, and I say only in a nice way, that's still really, really great outcome there for Jimmy.
Pretty solid goal kick.
Brilliant. It's brilliant, right? But if you're only going to get those 3 to 5 residentials and you feel like that's your number, it gets you to your goal, why go down those entities? That was Jimmy's scenario. Where with Mark and Sarah, they have an opportunity with their income, their equity, to tactfully use that to be able to not only get multiple properties, but scale over to commercial. And so more complex structure, if it fits their guidelines from advice from their accountant and broker, they're going to be in a position to benefit off those a little bit more than Jimmy has, because not only can they fit in those vehicles, but they can also actually have the cash flow management because of their higher incomes to be in those vehicles. Right? So I think, yes, that structure will come up more often now for couples like Mark and Sarah.
And something that we've talked about many times on the show before, like the first couple in your own name, first kind of 2 to 3 in your own name, then going into structures. Do you sort of see that being the most efficient way to grow as well? Or is it like, well, no, sometimes actually starting in the structure is still a pretty good idea?
Yeah, I think it's ambitions driven, right? Because some people, we're biased that we always talk property. And therefore we think everyone's only going to go property and that's the only way you can do it. But some people build wealth through their businesses. Some people build wealth through their other vehicles like shares. And some people have their super and they consider all these vehicles holistically. And as a result, they might think, well, I don't want to have a whole bunch of kitchens, roofs, houses to think. 3's enough for me. And if you're going to go to 3 or 4 properties and you feel like that does a great job for you and long-term you're going to sell them, maybe you think, why set up all these structures? But then if you're planning to really build a prolific portfolio, then yes, sometimes bringing these structures up nice and early can make a positive difference.
Okay, so what I'm hearing is it really comes down to the intention.
Yeah, it's all about the intention. However, it's much more beneficial for them to consider structures more so than Jimmy because of the position they're in, the incomes that are larger, the growth they're about to go through, and the aggression that may have now to really build some serious wealth.
Okay. What are the biggest mistakes that often hold a Mark and Sarah type situation back?
The single biggest mistake I see is the upsize and upsize and upsize. So once they got the home, they maybe dabble in their investment. Then once they've got the investment, they go, oh, maybe I should go back to buying another home. I'm thinking of this. The kids, we now have one kid turning into two into three. Just they're in this really maturing life stage, and like this 30s and 40s goes really quick. Like you're maturing in career, you're maturing in family size, dynamics, the family's growing through different age brackets. So like lots is going on. Preferences start coming up more. You see a lot more of your friends doing some things. This is the biggest mistake I see. People have an ability over 5 years with that 500K equity to drastically change their life from structured residential investments to transitioning to commercial over time. And instead what they do is they buy one, they feel good about it, then they go, you know what, let's focus on the home again. And then they go back to it and they're like, oh man, like we're 40 now. And so now you just continue to delay things. It's not the end of the world. There's a way out of it, right? Through downsizing that even bigger home eventually. But the main thing is you could be making some growth moves in residential during this time. And a lot of them go in and out and don't fully commit. They dabble.
I got some friends, lovely people, very hardworking people. They built the houses probably like, I'm going to say like, I think it's 2006, so 20 odd years old. When it was about 15 years old, they gutted the bathroom, gutted the kitchen, renovated it all. I didn't think there was anything wrong with the bathroom and the kitchen. They built a lovely home. They get new cars probably every 2 years. And again, not silly people, but they just, it's the constant kind of, it almost feels like a little bit of a keeping up with the Joneses almost. And I look at it and I think the amount of money that they would have spent on that kind of stuff, if it was invested into income producing assets like you're talking about, it's going to be completely life-changing later on. And I see that just in a few like friends and family members. Is this something that you see, like, and this is kind of what you're saying now with the upsides on the upsides, is it not just the house? Is it kind of like just all of those spending choices encompassing, like kind of coming together?
Absolutely. So I worked in the banks pre my role here at InvestorKit, and when I was in the banks, I saw a lot of like the activity kicks up around 34 onwards. So I used to have my fingertips in spending data, understanding what was happening in the home loan space, when things like net interest margin, so essentially when banks start making money on stuff, and all of that really kicks into gear sort of 34 onwards, right? It's not to say that there's people that don't make the moves in their 20s, but 34s is when life really hits you. It's like school turned into private, turned into college, or university starts coming up in terms of thoughts, and you're putting money away for kids, or anything that comes up. There's a lot of things that you start thinking with cars. One small car that got you around from A to B becomes the nice car, becomes the, do we get the 4-wheel drive? Do we get the Kia Carnival? Whatever it is, it starts picking up. And then all of a sudden sports, extracurriculars, then life gets really full on at work and kids. So you're like, I need a holiday. Holidays come up. And then you're going, well, it's a nice house, but I feel like we've been there for a bit. That suburb's a bit nicer. This is getting a bit busy down this way. Everything hits you in this 30s and 40s. So this is the prime age where people just really don't move a dial at all, or they lock in and they move a fair few.
If someone's resonating with this right now and they're like, yeah, okay, I can see this because I've seen those choices come up. I've had these conversations come up with my Mark or my Sarah. What are the questions they should be asking themselves to make sure that they don't get stuck? Because to me, this isn't just like, oh, okay, we did this and it put us back a little bit. Some of these decisions can actually put you back a decade or more.
Yeah, I think rather than questions, I'll basically give them a big pointer. A lot of that activity happens and lack of activity happens from desire and fears. So the desire is to do all those things in life because it's a fun period of life, right? Like kids are growing up, all those milestones. But the fears are, I may not have enough money. Do we have enough for this? There's this deep look into budgets, money in bank, and it's constant like, job security, all these things that are there because a lot's going on, but a lot can be taken away or a lot can be mismanaged. And so when you're equity rich, like many 30s and 40-year-old couples are, who have got a kid and that 300 to 500K income, pull out equity, right? And when you pull out that equity, call it that 3 to 500 equity or 4 to 500 equity in this scenario, pull out a little bit more than you need and leave it in an offset account.
Expand on that because a lot of people will be like, why am I doing this?
Yeah, so I did this for an example in 2021. We pulled out 600,000 of equity against our portfolio and only used 200 to 300,000 of it for some investing and left the rest in the offset account. What that does for you is firstly, when it's in an offset account sitting there, it doesn't charge you money because it's not charging you interest until used.
This is provided it's interest only.
Correct. And even if it's P&I, it's just eating against its own balance anyway. It's going down at the same rate because it's your money offsetting the loan, right? So I think the key there is that's the first part. Mental resilience changes massively. You're looking at that balance now going, we're good. Like, what do we keep thinking about? What about this for primary school, that for private school, or this for that? Should I get this? Should I not get this? Mental wise, you get peace of mind. The second thing is you can start going, well, we got enough for investing. Okay, well, you can start getting some investing runs on the board. Now, let's just say you're kind of disciplined, or maybe even say you're not. If you're kind of disciplined, you're going to look at that cash and going to go, okay, well, I'm locked in, I'm focused, I'm not going to go and spend these extra things, but I'm glad to know I've got that extra money there. I'm doing it because it's my focus and my choice. I'm not doing it to starve myself. I see that money there, right? But if you're not kind of as locked in as you should and you do spend a little bit, it doesn't change your position as much because there's a healthy buffer sitting there, right? And so I think this mental resilience piece can't be understated. Like, it is a big impactor. Obviously, there's risks that come with it, a whole bunch of cash, and you go and buy a boat or you go and buy a car and buy silly stuff. I've seen some people do that. So, but that's like anything, like, you know, you're going to have some people that just don't follow rules and some that do. The key here, though, is that I would unlock money, leave it sitting there for myself. I would see that resilience then given to me and I would go, okay, now I'm committing to investing and I'm good. If something comes up in that, you know, kids growing up age or life changing phase or family moving here, or we need to go for a trip or here, I think I'm good for it. I just want to focus on my wealth building.
And it does change the way that you look at it. Like, do you remember one of your first equity releases? And I remember mine, I think it was like 25 grand or something. It's hardly anything. And then all of a sudden the next one was like 100 grand. Then the next one was like 300 grand. Then the next one was like $500,000. And the level of confidence that you feel when you look at your situation, you do your financials and you know you've got it sitting there, as long as you've got the financial discipline to not like jet ski safari and just like waste it on stuff, you're totally right with that. It really changes the way that you look at it.
Changes your mind. Like, you even get, I know big call here, but you get better at work. Right? Imagine, like, because, you know, financial struggles impact your day-to-day life at work. Your financial mindset impacts your day-to-day life at work. If you're looking at your offset account and it's flush with a couple $100K, I think your days go a little bit smoother just from a mental impact. And my work focus, my things, I'm not rocked by every bit of thing that comes my way. Oh, hey, honey, the shower head broke. Or, hey, the aircon seems to be, like, do you know what I mean? Like, these things don't rock my mentality. I'm just locked in on what I do. And I feel like you can't underestimate just mental resilience and offsets, funds, balance management like that is mental resilience.
So as far as mistakes are made, realistically, we're talking about upsizing too much, spending too much. As far as curing that mistake and really trying to sidestep it from happening to you, we're talking about improving your mental resilience, making sure that if you've got some equity there, release it. Talk to your accountant, your financial advisor to make sure this is the right choice for you. If you are in a position to actually release that equity, put it in interest only into an offset account, it's sitting there. I'm totally picking up what you're putting down as far as the way that you're going to look at things is going to change in a very positive way. The options that you've now got as well, when you start looking, it's not, oh, okay, we're kind of just looking at realestate.com because it's fun. You're on there and you're like, we can do this.
You can take action. And that's the next thing. Just take action. Because this is the most important. You're making money in this age. You've got equity in your home. You've got time in life. You're not too tight to the finish line. This is the game-changing part for many, your 30s and 40s.
Love it, man. All right. So as far as their keys to getting there faster.
Keys to getting there faster, it's very similar through all of them. It's going to be whether you downsize or not. That's going to be the big X factor. Whether you buy aggressively in residential and transition a lot of them into commercial at the end. And then also we haven't factored in things like super and other things like that that give that extra bump. But this particular key is going to remain the constant across everyone. It's the downsize, it's the commercial, and it's the super. These three things. Obviously, how much you earn also changes. The savings ratio you get changes, but that's going to be the most common factors across all three.
Okay, so really the key for Mark and Sarah to get there faster is the reversing the mistake. Don't over upsize, don't overspend with everything. Make sure that you're having fun in those 30s and 40s, but not so much that it comes at the financial detriment of your 50s and 60s.
Absolutely. Like, that equity is going to put you in a position to get multiple residential properties in quick succession and even eventually transition to commercial, potentially without selling anything. So you're in a position here to get all the assets across foundation, momentum, and passive. Don't stuff it up.
Love it. Let's talk about Sanjay. He's like, I don't even know if we're going to talk about keys to get there faster. He's already moving at lightning speed.
Yeah, he's on a good wicket. He's got a large value home. And we spoke to quote unquote a Sanjay just literally 2 days ago, right? And so the key here with a Sanjay type scenario is this. He's looking for age 60. And, we could be between 50 to 55 here for Sanjay. We'll call him 55, which makes it 5 years. And if you wanted to make it 10 years, we go to 65 when we're near that sort of pension age and all that sort of stuff. Well, but he's not getting any pension.
Sanjay, I reckon he's probably not qualifying for that.
Probably. But the main thing with Sanjay here, they've constantly gone through upsizing the family home. So this is also relating to Mark and Sarah's example where it's not actually the end of the world if it happens, but it just means you've got less choices and you've got to be very aggressive. Right? That's the key.
And you also need the higher income that Sanjay's got, because then if your income started plateauing and you made all those choices,
Absolutely. So Sanjay's gone up through the corporate ladders or business ownership, and that's possible now. But with Sanjay, we're going to call the home circa $5 million. And this is that, scenario from a few days ago. And in this particular scenario here for Sanjay, if they want to get there in 5 years, well, if they've got almost little to nothing loan here paid off or near paid off, well, they're going to be able to firstly use the equity or cash they've got to make 1 to 3 commercial properties. And we're going to call these commercial here, depending on their income goals. In this case, it was sort of 250K, inflation adjusted. So commercial is really going to be the only vehicle to make this happen with quick speed.
It's probably not that much inflation happening in a 5-year period for him. But
yeah, it depends if another pandemic hits and it goes crazy, right? So, but that basically is the key here, where we're transitioning the equity in the home or cash that they've got on the side to deposits in commercial property and getting 1 to 2 or 2 to 3. And the reason why I don't say just 1 is that in Jimmy's scenario, maybe you can only just get 1, and unfortunately that's just the scenario. But in this scenario, you might get 2 to 3 commercial properties, and the importance of that is that you're actually having diverse streams of rental income. You don't want to have streams of rental income that are just one stream and it gets vacant for 3 to 6 months, and now that passive income is really, really hurting you, right? Because it's not there.
Gotcha. All right. So how much is he spending on each of these commercial properties? This is like the 1.5 to 2.5 or what?
Yeah, in this particular scenario for the Sanjay from earlier this week, it was actually 2 mil plus.
2 mil plus.
Right? And in these scenarios here, it's because there's rich equity, there's savings, there's high income, there's high rental income in these commercial properties. This happened for the scenario that we drew out for a client. In their case, it was just 2 properties, but I'm just showing that 2 to 3, depending on how aggressive Sanjay wants to go.
Yep.
Now, the big X factor here is what the same thing we mentioned before, the downsize. You've got a $5 million home near paid off. You're going to be able to go from that wealthy home to a unit, right? And if you're in that unit, the units might be somewhere between 1 to 2 million or 1.5 to 2.5, because we still want to respect Sanjay might have had a bit of a lifestyle creep, doesn't want to be in that worse home. He wants to be in a nice unit in a great spot. That's okay, right? You worked hard. You've been there since, all the way to 55. You got a good income. Why not?
You can still see the water at Double Bay for 2 mil.
Yeah, absolutely, right? But the main thing here is we're trying to use that 5 years of high income, high money and offset, positive cash flow from commercial going back into offset accounts, sale of the downsize to really clear the debts so we can have commercials that are debt free, right? That's going to be one option. If Sanjay feels though, hey, look, I want to get a higher income, or I'm not quite ready to get off the tools at 60 and I want to extend it to 65, this is where the speed or aggression can happen in 2 different ways. One is you could go more residential properties and then again exit them, and you have that growth and loan to value ratio that you can utilize. Or you may just get to more commercial properties and see where you get how much you can exit to get debt free by that time. Because at 65, 67, the super may again be another vehicle around the corner to help extend this figure.
How are you sort of approaching this differently? Because I know that as much as you want the highest amount of growth in the shortest possible time, but if you're in like more of an early adopter kind of market and you're like, Sanjay, this is where it's at. But if he's only got that kind of 5 to 10 year window, if this is where it's at has external factors that change it, now all of a sudden it goes from we were expecting growth in the first like 1 to 2 years, but now it's more like 3, 4, 5 years. Is there certain buffers he needs to put in place, or is this why it's like, no, this is probably why you'd go more commercial because the yield is so strong, it has like a debt pay down element to it? Like how do you approach that?
Yeah, it's a really good point. So this is where Sanjay's risk profile and age comes into factor. If Sanjay is aiming for 60, in 5 years, you can't just bank on growth alone. We're talking income is around the corner and that's the goal. right? So from that perspective, commercial comes ready to go from the get-go because the growth is already happening in this $5 million home. That $5 million home will continue to grow and outpace unit price growth. So when that downsize happens, that's going to clear everything. So that's where income is the focus.
Gotcha.
But if Sanjay goes, I'm willing to take some growth focus and I don't mind buying the commercial on the 5th year, then you could fill up the first 4 years of residential, get the maximum growth you can from high growth markets in that first 1 or 2 years of purchases. And if Sanjay says, maybe I'm open to 10 years. Well, okay, we'll spend the first 4 years buying residential. We'll maximize that, or spend the first 2 years buying residential from your equity, maximize that. And then when it's time to get to that 9 to 10 year, we'll sell everything down and transition to commercial. So the key is Sanjay's risk profile of carrying debt. The key is Sanjay's aggression. The key is to his goals. If it's going to be 60 or 65.
Yep. So when he's buying these commercial properties around the 2 mil sort of mark, what kind of yields, because you were talking before around that kind of 5.5 to 7 net yields, we're talking like some already positive cash flow sort of properties, or is it still like it's a almost positive cash flow?
They're already very positive, especially if Sanjay's got cash on the side to put down his 30% deposits. If Sanjay's going to be getting the cash from his equity, then they're not going to be positive because you're lending everything through.
That's kind of what I was thinking. Yeah.
That's right. But then if the loans are near zero for the $5 million home, and even if you're lending sort of $2 million worth of lending for these 2 properties, or $2 to $3 million of lending for these 3 properties to be the deposits for 30% plus costs, yes, there won't be cash flow, but that's not about the cash flow today. It's the cash flow in 5 years plus when that $5 million home has only got about 2 to 3 million debt on it. That's grown to about 7 million and they're selling tax-free, clearing all that debt and some of those commercial property debts that he has as well.
Gotcha. Okay. So without the home, basically this strategy doesn't quite work the same way. I mean, at the end of the day, building the portfolio, I don't care how much money you're on, in a 5 to 10 year window, that's a pretty solid goal kicked. So being able to do it on a higher income, but it's really coming down to that debt pay down at the end from the PPR. And like we've discussed in others, we haven't even really talked about the potential with super pay down too.
Absolutely. And look, if Sanjay, say, is on that income, but maybe he didn't achieve the $5 million home, then you're kind of coming back to Mark and Sarah's example, where it's just a little bit less prominent downsize. And Sanjay may have to go through some more residentials to really pull up the value growth and then transition to commercial after they've sold everything, downsize inclusive, and then the commercials just come up afterwards with no debt. In this scenario here, Sanjay can get the commercials from the get-go because of equity, because of income, because of life stage. That's the key difference here.
All right, so finally for Sanjay, what are the most common mistakes you see a Sanjay make?
The most common mistake I've seen them make is actually not embrace that new wave of, asset buying, which is commercial, because they've just gone through life being in residential. They've only seen it with their home that they live in. And so sometimes the Sanjay, even on the good wicket, the smart person through their career, building that, getting a great sized home, it's just the uncomfortable parts of transitioning to something so foreign to them. At the last 10 years of their life, something that's like, this needs to work, and it's that hesitation. And often what ends up happening is they'll either continue to put it off the home, or they'll go down to the most comfortable residential investments they like. And even if those residentials grow well, they'll realize growth on paper doesn't equal income. You need to transition from growth to income. So I find Sanjays, even though you'd be surprised with income growth in a $5 million home, actually suffer a lot from like lack of action and lack of expanding their wings, even though they've done that in other parts of their life, like career, like their home.
Is it because you're so focused in the career side of things, you kind of get swept up in it? Because like if you're really climbing the corporate ladder to proper levels, you're not doing 40 hours a week. You are living and breathing that job. So do you find that people in that kind of like scenario, it's just, they don't have time?
Look, I don't think it's a time thing because this group is actually embracing professionals most often. Like if you look at our client base, when it's the Sanjays, they're the ones who are ready to go the quickest. They're the ones who are saying, I'm ready to do this. I want to do this. But then as soon as commercial gets dropped in the picture, it's a little bit tougher for them to comprehend to go, oh, so I need to make this big move. Like
right, okay.
That big move.
So it comes back to that comfort and the mental shift.
Absolutely. It's like, why can't we buy the house? Why don't we just focus on that way? We can. But I mean, hey, if we're buying a house now and a house in 3 or 4 years, you just wipe the debt off them and they're still not going to get you the income you need. Because remember, you're used to a 500K income life now. Even if I tell you to half it and be at 250, 2 houses aren't going to get you that. So the key thing is I find that they're ready to make moves. They know they have to, but they didn't realize the extremes of the moves they need to make to really make this monumental shift because you've only given us 5 years. And that's where the big mistake is. It's to go, I can get there. I have the power. I have the position. I'm very blessed and fortunate to be able to do that, but I'm not doing it, or I'm not doing it the way that really gets that income that I'm after.
But you start making the moves at more so Jimmy's age, Mark and Sarah's age, a lot of the pressure's taken off.
Absolutely. Now it's like you've got that. You're going to get to a sustainable income, but to really just level it up, you're like, oh, to level it up, I need to do that. Okay, we'll consider that.
All right, so if anyone's listening to this right now and they're thinking, all right, I'm a Jimmy, I'm a Mark and Sarah, I'm a Sanjay, what's something that they can action step straight away? Pull out the headphones and just put into practice to start walking their path and really, I guess, putting a portfolio together that's going to get them where they want to go, avoiding the mistakes, using the right structures, and really the keys to get there faster.
Yeah, so I think hearing all of that, I'd firstly say that look at the good news that in 10, 20 or 30, high income, coupled income, lower income, but still solid, all have achieved a result that gets each of them to their individual goals. And so that's the beauty about this. It can work. And the variables to consider are, do you have that time, right? 10, 20, 30. And then secondly, are you actually structuring it through your actual consolidation and acquisition phases? Don't think that property is about buying. No one celebrated at passive income stage with lots of debt, getting lots of income. It doesn't happen. Usually the debt goes, or the debt's in commercial and the income's much higher and the assets are much higher, right? So the main thing though is that, you have to celebrate getting rid of stuff. That will get you to your goal. And so that will be a key. And then the third part is that when you're actually looking through all of this, just make sure that the goals are actually matching to where you are today and where you think you could be. The key is if you set the goals of, say, I'm Jimmy's income and I want to do it by 2030, it's not happening, right? You're not going to get to the 100K income, Jimmy, at 90K income today and get to that, in 5 years? So that doesn't happen. Retiring by 2030 won't happen for Jimmy in that 90K income scenario, because even if we had, trust structures and got you 2 or 3 residential properties, like where does the pay down happen? Like your income's not high enough to do that. Your savings per month isn't high enough to do that. So you've got to have those goals assessed, and this is where a team around you can get that happening. This
is where I'm also hearing like the acquisition and consolidation. Almost if you start breaking the portfolio up, because I feel like when I talk to people about building a portfolio, it's usually just building a portfolio. It's like it's one big thing, one big timeline. But if you start thinking about it as an acquisition phase, and I'm going to add another one in there and you tell me if this vibes with you or not. If it's an acquisition phase, the almost like taking a knee, letting it do its thing phase, the time in the market phase, and then the consolidation phase. Because if you can acquire as much assets as you can that do the job that they need to do first, have as much time in the market, but then go through that consolidation phase, you're building yourself something pretty special, even if you're starting on 90K a year like Jimmy is.
Absolutely. And the key concept to that is going through phases and having the right time, right? If you condense that too tight, you'll get the growth, you'll get the equity. You might have all these success stories of going, I went from 1 to 3, 2 to 4. But you went from 2 to 4 by leveraging equity, pulling that equity up to get to the next. So that equity and value is quite close to each other. Where's that time to let it simmer, right? Where's that time for the gap to happen? So if you did consolidate and switch over to commercial, there's money there to be happening, and that commercial is actually debt free, which is why if you match all these things together, then you'll get there.
I told Bianca a story last night, actually, of when me and a friend used to live together in an apartment just down the road, and I was making, this is when I used to drink, and I was making a bolognese gnocchi, right? And I just got too drunk and I accidentally left the stove on. This is like classic, could have burnt the house down, but it was on the lower setting. And I remember waking up in the morning and the house smelled so good, like just amazing. And then, but when I got the actual part, I tried to make it again afterwards. It was like this crispy little shell around it, but then all loveliness. But it was the time in the, I've never made a gnocchi again that tasted so good. The time in the pot, the time that it simmered for, it brought it out. And I couldn't have done that quicker. And I'm not recommending you get drunk and just buy a house and just wait. That's not actually the moral of the story here. But it's like some things you can't be replaced that need time. They just need what they need. But then if you let it do its thing, it can produce such an amazing result you can't get elsewhere.
Absolutely. Well said. Well said, mate. That's the thing you need here. Time, whichever scenario you're in. Unless you're in Sanjay's scenario, you need aggression, make moves.
Yeah. Well, he's probably used to yelling at people in boardrooms anyways. He's climbed his way up.
So that's it from my side.
Mate, speaking of food, I've asked you this question. I've actually lost count how many times now.
Yeah,
it's 2025 now, and you've been traveling around the world quite a lot lately. I'm going to ask you, Arjun Paliwal, what is your favorite pizza that you've had out of Australia? Because weren't you in Italy recently?
I was in Italy recently, actually, so it's a good point.
You must have had pizza there.
Yeah, it was really good. But man, I'm sorry to my Italian friends. Italian food in Sydney is better.
I've actually heard that.
It's so good in Sydney. It's so good. So I'm going to go with just a really, like, say, a nice restaurant in Sydney, Italian, that does the pepperoni, chili oil, and that little sweetness with like honey sort of taste to the bread.
Yeah.
That's where it's at.
Okay, so you're going Italian, not in Italy, in Sydney.
I'm so biased with that, but I honestly, like, if I just had a whole bunch of like randoms that never met me before, that hated my opinion about this food thing, and I just said, can you please come with me on a plane to Italy? Let's go to these 5 places. Come with me on a plane to like even Thailand, and then come to India and all these countries, right? And then come back to Aussie and go to these 5 restaurants here and just be honest about it. Let me know your thoughts.
I've had that literal experience in Thailand. I prefer Thai food here down the road.
It's creamier.
Yeah,
you know
it
what I
is.
mean?
It really is.
And look, I know that like we're like botching traditional food in a way, but taste is taste.
Well, that's what I was going to ask you. As an Indian man, as someone that's obviously been to India and now lives in Australia, what's the difference there?
Yeah, so here's the thing with that. Okay. I've been told, I haven't been to London before, but I've been told London has the best Indian food in the world.
I've been told that too, yeah.
But when I look at my time in India and the food there, India's got the best street Indian food in the world.
Okay.
Like the street food's just unreal. And I promise you, for all those who laugh at the YouTube videos that like the street food like looks really bad or unhygienic, it's like someone's only recording 10% of the street food out there.
Right, okay.
It's like most of it's really tasty and it's amazing. So what I would say is Australian Indian food has one problem though. A lot of my fellow Indians will come over and go, I don't want to work for someone, I'll just start a restaurant. And so it's a lot of people who aren't in the trade, they just want to start it, and therefore it doesn't get the best quality food out. And so you get a lot of Indian restaurants at high quantity, but not a lot of them are great. And then the Aussies don't know otherwise because they're just going to have butter chicken and naan, whichever one they go to. So it ends up being the same thing. So it's a tough one with Indian food, but I would say that if you go to the best Indian restaurants here, again, biased, it's beaten the best there, right?
Okay.
So, but then I think my fellow Indian friends could go, you've never been to good restaurants in India, and that could be true. So this is where it gets tough, right? I'm playing very political card here because I don't know which way it could go. But I would say this: Italian food in Sydney is next level. So pizzas in Sydney, I'm hands down doing that.
Yeah, and next time you and I catch up there, we've got to actually go out for a pizza at one of these places.
Done. Next time you're in Sydney, I'm taking you to Ciccerone.
Let's do it. I think I'll be there in April. But anyway, that's a whole nother discussion. Mate, this has been a fantastic episode because I talk to people at all different walks of life all the time. The amount of messages that I'm getting from people that are Jimmys, that are Sarahs. I don't talk to as many Sanjays. Sounds like you talk to a lot more Sanjays than I do. Few. But people that just want to know, like, what does it even look like over the longer term? What are the kind of assets? What are the kind of things I want to do and not do? This, to me, has brought a lot more clarity to it. And I reckon we're going to chop this one up as well in the chapters on YouTube. So it's going to be nice and clear. You're a Jimmy, check Jimmy's section out. You're a Sanjay, so on and so forth. But otherwise, Arjun Paliwal from InvestorKit, thank you so much for jumping on the show, mate. This has been a really good chat.
All good, mate. It's been really good fun. These are portfolios we see every day, and to run through them like this, it's been special.